Hello, everyone. I constantly get feedback from realtors that their clients are buying with cash, and my constant question is why? For most people, buying with cash is not the greatest idea. So today we're going to talk about whether getting a loan instead of paying cash is right for you and whether or not the opportunity cost is something that you want to take advantage of rather than leave on the table. So here we go. So why am I bringing this up? There's a few reasons that you want to get a loan rather than pay cash. Uh, from credit to the IRS rules, you know, to the crazy savings rate. So right now, credit. If you look at myfico.com, it explains to you that the algorithms that generate your credit scores hold mortgages at the highest standard. So they're the ones that solid payments on your mortgage is going to give you the best possible return on your credit score. IRS rules, publication 936 says that acquisition financing is the financing allowed for tax deduction. If you don't have a loan, now that doesn't mean you have to have a loan on the property when you buy it. So if you have cash, it might be a good idea in your market to pay cash so you can go very quickly. In some markets, that's a benefit. In some markets, it doesn't matter. You need to speak to your agent about that. The acquisition financing, however, doesn't have to be at the time of purchase. It just has to be within 90 days according to IRS rules. And as far as bank rules are concerned, you can get, if you do that loan within 90 days, you can get purchase money terms. So that means a better interest rate, etc. So lower points, that kind of thing. Um, right now, savings rates are insane. I'm going to go over that on the next page, but it doesn't make sense to leave some of that money on the table. And finally, there's no prepayment penalty on conforming owner-occupied purchases. That's just not allowed. And you can't sell your loan to Fannie Freddie if you have a prepayment penalty on an owner-occupied purchase. You don't meet the standard required for safe harbor. So nobody puts them on there. And so anytime those savings rates drop and you don't have any other investment opportunities, you'd rather not have that mortgage payment, or the refinance opportunity isn't there yet, pay it off. It's fine. You can always refinance and get cash out again. So the next question is this for you? And so I think it's going to be for you if you're a seasoned homeowner, you've had experience making mortgage payments, you know what it means to maintain a house, etc. And you're not a rookie. Let's just put it that way. If you're a diligent money manager, in California, lots of people don't allow the bank to collect taxes and insurance on a monthly basis because they feel like if they put that money into their savings, they can earn a return on that while they wait for tax time, which by the way is November and February in the state of California. All right. This may not be for you if you are a first-time home buyer and you have no experience with this. If you used a gift to pay cash, we can't return a gift. Or if you used unsecured assets to pay cash, then we won't be able to get that back for you either. However, one thing I forgot to put on here is that also if you're a retired person and you just want to be done with that, and you're going to be buried in the backyard of this place, you just go ahead and pay that thing off. There's no need to put your future at risk. So that's kind of a general idea of who this would be good for. Now, the next question is specifically why do this? And as I mentioned, savings rates are insane right now. So the opportunity cost of that $750,000 going into equity on your house. And let's be clear, when you put money into your property, whether it's sweat equity, whether it's home improvement equity, or it's paying down your principal mortgage, especially when it's paying down the principal, this is money that's at risk because if the market drops, your dollars are bank's not sharing in your loss. Whether or not you have a loan, those are your dollars that go away. And at the end of the year, $1 paid into equity is still $1 if you're lucky. If you hadn't lost value on your property, so it's always better to pay as little principal as possible and put as much money in savings or other investments as possible. as long as you're okay with the risk. That's key. So, and that's kind of what I'm here for, to walk you through that. Right now, we have 5.4% at some of these banks. I just pulled this stuff online 5 minutes ago. The 9.24% if you invested in the S&P year over year. If you want to make home improvements, you don't want to pay cash and then not have any money for that new sink. And then also, it's kind of nice to have reserves. So if you're wiping your cash out by paying cash, get some of that back and let it sit in reserves. So I'm going to walk you through a couple of scenarios. In scenario number one, we have uh, taken your $750,000, gotten a loan, got that cash back after you purchased the property. So you used the fact that you were paying cash to get that market incentive to get the sellers to take your contract. And then we put that $750,000 in a 5.4% passbook savings account. So at the end of 1 year, and I use 1 year because it's just easier across the board, and it also looks the best. So the mortgage interest rate deduction obviously diminishes year over year because on an amortizing loan, you don't pay the same amount of interest every year. But in the first year, at 5.4%, the balance on your savings account will be 782,000. After a 20% capital gains, you're looking at 32,000. The rate on the new properties, I just pulled it today, 8 1/8 is a pretty solid rate. 750,000. At the end of the year, you will have paid down so that your balance is now about 740. But you will also get about $9,000 in additional tax deduction beyond what your standard deduction is. If you add the interest you paid to the amount of additional assets you have at the end of the year, you can backwards calculate your effective interest rate on that loan, and it's less than 2%. In history, that is a relatively small price to pay for that peace of mind and your ability to use those assets for other things like emergencies or additional investment opportunities. In scenario two, we assume that you put your money into the S&P 500. Now this is interesting. I showed you at 9.24 before, excuse me, 9.15. That's because 30 seconds later, when I looked again at the rate to make this slide, it was different. So at the end of a year, you'll have $805,000 in the bank after a 20% capital gains tax. You have $55,000. You add that to your tax deduction on the mortgage, comes up to $63,000. That's more than you paid in interest. That gives you a negative interest rate. So they're paying you to have a loan. Makes no sense in that scenario for sure not to get a loan on the property. Again, there's no prepayment penalty. If this thing changes or you get cold feet, cash everything out and pay down your mortgage. Again, I don't think that's a good idea. In fact, I think interest-only loans are the best loans because of that principal thing we discussed, but that is an option for you for sure. Thank you so much for listening to my presentation today. I hope you got something out of it. My name is Michael Collier. I'm with Mason McDuffie, and I would love to help you out with any loan questions you have, whether it's owner-occupied, second home, or investment properties, any 1 to 4 family properties you have. I'd love to help you out. If you don't have an agent, I'm happy to refer you to one. My phone number again is 650-288-8170. I look forward to working with you. Have a good one.